Hello guys, welcome to another training video. This is Ahmed Al-Azaiza of Forex Trading Signal. Today guys, we're gonna go to discuss about the Consumer Price Index, the CPI indicator, and we're gonna go to learn how to calculate it to understand it properly. So we're gonna go to explain the indicator and what are the factors affecting the indicator and so on. So stay with us please. We will start in a moment. We have explained before, guys, the economy cycle, and we have spoken about the household and the output market and the firm and the input market. So far, we have spoken about this cycle several times. So we have spoken about the household and the output market and the firm and the input market. However, we have spoken about some indicators in this cycle, and we have said that the central bank will use the tools of interest rate and money supply to control those indicators. So in the previous video, we have discussed about the gross domestic product, which is the GDP. And today we're going to go to discuss the consumption, which is the CPI. So moving forward, we need to know what does the consumer price index mean? So what does the CPI mean? So you know from the previous video, we have spoken about the money amount in this area, and we have said that we can measure in this area the GDP. However, we have also calculated the GDP deflator. So today also from this area, we're going to go to measure the CPI, which is the consumer price index. Why we need to measure it in this area and you cannot measure it in any other area? Because we need to measure the household spending in the output market. So the consumer price index is about the consumption. So if we ask ourselves, what does the consumer price index measure? So it measures the prices for the goods and services which is consumed by the household, by the individual or by the group which is living under one house or one shelter. So there are several products and services being sold in this market, and the household, they are spending on these services and the products. And this is one of those example. So a typical household will spend on education, medical care, food and beverage, and housing, fuel, public transit, and other stuff and services. And also the CPI measures the typical goods and services which is needed by the household. So it doesn't measure everything which is consumed by the household. So those things which are typical and used by the household, which are common, we collect them all and we group them and we put them in a basket. And we name those typical goods and services by the basket. So the term basket is very important. Basket mean a group of goods and services required by the household, and the household is going to spend on those goods and services. Such as, for example, me and you, we need petrol, we need fuel for our cars, for heating our houses, for our factories. So the fuel is important and the fuel is typical. So for example, the food in general, it's required by everyone, and so on. So in the previous videos, I have spoken about the basket and I have shown example for a basket. So let's now understand how the CPI calculated. So to understand the CPI, and let's in this example explain again what does the basket mean. So the basket means again a typical group of goods and services required by the household, and the household will spend on that goods and services he need them. So for example, transportation, clothing, communication, education, food and beverage, housing, and so on. So we call these goods and services, and we collect them all in a basket, and we name that group for the goods and services a basket. So for our example, let's think about simple example. And in this case, we're gonna go to fix our simple basket. So let's think or assume that our basket for typical consumer is 4 hot dogs and 2 hamburger. So you remember that we have taken this example in the GDP explanation. So I'm again taking this here so we can use the same example every time so you get familiar with what we are doing. So let's say that a 4 hot dogs and 2 hamburgers will be our basket, and we want to calculate the CPI based on those data. So next thing you're gonna go to do, you're gonna go to find the prices for the basket. So let's take again the same prices which we have taken in 2001, 2002, 2003 on the GDP example. And let's say that the hamburger price was in 2001, $1, 2002, $2, 2003, $3. And here for the hot dog prices, 2001, $2, 2002, $3, and 2003, $4. So this is what we meant by fix the prices. Those are the prices for the previous years. Next thing you're gonna go to do, you're gonna go to compute the cost of the basket. So our basket is 4 hot dog and 2 hamburger, and we're gonna go to compute now the cost of the basket. So let's do that. So to calculate the cost of the basket, you need to know in 2001, what was the price for the hamburger and what was the price for the hot dog. And we said that the typical consumer will consume 4 hot dogs and 2 hamburgers. So let's calculate the cost of the basket in 2001. So 4 hamburgers multiplied by $1 in 2001 plus 2 hot dogs multiplied by $2 in 2001. So total 8. So next, in 2002, the prices raised up. So we have had 4 hamburger and the price for hamburger was $2 plus 2 hot dog and the price for the hot dog was $3. So total price is $14. So in 2003, we have 4 hamburger and the price was $3. And we have 2 hot dogs and the price was $4. So the total price of the basket was $20. So you can see that in 2001, the basket cost $8. In 2002, the basket cost $14. In 2003, the basket cost $20. So next step we're gonna go to do, we're gonna go to choose the base year and calculate the CPI. And in this case, we're gonna go to follow this formula. So let's say that we're gonna go to take the 2001 as a base year. Then the formula is the CPI equal to the cost of the basket divided by the base year cost multiplied by 100. And this will calculate for us the CPI. So let's do that. So to calculate the CPI, first of all, let's take the first year as a base year. So the base year, the basket cost $8. And the base year itself, it's the same year, the basket cost $8 as well. So 8 divided by 8 multiplied by 100 is equal to 100. So if I take 2002 as a current year and 2001 as a base year and apply the formula again, so in 2002, that is the cost of the basket in the current year, so 14, divided by the base year 2001, which is 8, multiplied by 100, which will be equal to 175. So you can see now CPI in 2002 has changed by almost 75%. And how you will know that? By subtracting 175 from 100. And in a few moments, I'll give you a simple formula to calculate this properly. So let's go for the next one. So in 2003, the cost of the basket was $20 and the base year was $8. So the current basket was $20, 2003, divided by the base year, which was $8, multiplied by 100, which is equal to 250. Now, the next thing to do is to calculate the inflation rate, between the first year to the second year to the third year. So we'll do that by calculating the inflation rate, and there is another formula for that, simple formula, which is the current year minus the base year divided by the base year multiplied by 100. So we call that the inflation rate. So let's calculate this one between 2001 2002. So if I calculate the current year 175 minus the base year is 100 divided by the base year, which is 100, which will give me 75% inflation rate. So I can see that there is an inflation rate between 2002 to 2001 by 75%. And if I calculate now the inflation rate between 2002 and 2003, I will find out that it is 43%. So if you realize here that I can calculate 2003 based on the base year, and the base year, it doesn't matter because you are the one going to select the base year. So if you selected 2001, the total inflation rate will be 150%. However, if I calculate 2003 and take the base year as a 2002, the total inflation rate will be 43%. And this is how to calculate the inflation rate. So if I want to calculate the inflation rate between 2003 2002, so in 2003 the CPI was 250, in 2002 the CPI was 175, so 250 minus 175, and I have taken this as a base year divided by 175 multiplied by 100, which is equal to 43, and we call this the inflation rate. Now let's discuss the CPI was the GDP deflator and the interest rate. And this is very important. So there are some facts which you need to know. The CPI is about the consumer. It's not about the productivity. So the CPI measure consumptions only, doesn't measure productivity. To measure the productivity, you need to look into the GDP calculation. The CPI uses fixed basket, unlike the GDP. The GDP is using the products and the quantity of the products. However, the CPI is calculating fixed basket. Let's say you needed 20 liters of fuel per week. That is only 20 liters of fuel per week. No more, no less. So the GDP deflator is about domestic product. We said that. And the GDP, there is no fixed basket. It is all about the productivity and how much we produce, how much we supply to the market. So let's now take example of the inflation to understand what does the inflation mean properly. And I'm going to explain income plus inflation. So in 1931, a football player salary was $80,000. So we need to find the salary in 2018. And this is only as an example. So now the CPI in 1931 was 251.1, and the CPI in 2018 was 15.2. So the way we look into this, we're gonna go to find the salary in 2018. So we're gonna go to take the salary in 1931 and multiply it by the inflation rate in 1931 divided by the inflation rate in 2018. Then we come with the final salary. So the salary of a football player was $80,000. But if you look in 2018, the salary of football player is $1,321,579, which is less than what they take currently. They are way ahead of this salary. So now this calculation based on what was the CPI in 1931. So we measure the income and we compare it with the current situation, and we calculate how much money we need to live the same standard which we have lived in 1931 in 2018. You can see now that the football player is taking away much money more than that. So you can see that the inflation raises, however, the salaries also and the income also raises as well. And this is what we will discuss in next video. So now let's understand something about inflation and interest rate. And let's take as an example here your saving. So let's think that I am going to save money in a bank, in a saving account, and the bank is offering me interest rate. And let's put a simple number of interest rate so it's easy for us to understand and calculate. Let's say I'm going to deposit $100 and the bank will give me 10% interest rate. So that interest rate is called the nominal interest rate, the one the bank will give you. And what does it mean when I have saving $100? That means I have a power of purchase of $100. So now, what happened to this power if the inflation raise up? So let's take in this example, let's say that I have deposited $100 and the bank will give me $10 interest rate, and that is the nominal interest rate, and I want to calculate the real interest rate. And let's say on that year, the inflation rate was 4%. So the nominal interest rate is 10%, and that is what the bank they're gonna go to give me on my deposit or my saving account. So now to calculate the real income from your interest rate, you're gonna go to subtract from your interest rate, the nominal interest rate, the inflation rate, because prices of goods and services are rising up, and your money is the power of the purchase. So if the inflation raises by 4%, that means the value of your money gone down. So that means the value, the purchasing power of your money gone down by 4%. So you are earning 10%, and that is the nominal interest rate. So you need to subtract from it the inflation rate to come out with your profit, which is 6% a real income. So what happens if you hold cash and you don't put it in saving account? So well, if the inflation remains at 4%, you are not earning any interest rate on your money. That means you're going to go to lose from your money 4% for the inflation rate. Let's say that you have deposited your money in the bank and the bank has given you 2% interest rate and the inflation rate is 4%. Well, you're going to go to do the formula again. The nominal rate is 2% minus 4% inflation rate. So you are losing 2% from your money, from your saving account. So the real interest rate will be 6% when you have a nominal interest rate 10% and inflation rate 4%. And your money is your purchasing power. So if the inflation goes up, your purchasing power will reduce. If the inflation goes down, your purchasing power will increase. So now we're gonna go to explain the economy cycle again. We have explained it last time, but however, we're gonna go to repeat it again and again so you guys, you will understand what is happening with the market. So this is the GDP cycle and the inflation cycle, the economy cycle. And let's say that the central bank, he want to maintain the mid area, this area as a target, by dividing this cycle into two terms, which is the expansion and the contraction. And let's start with the expansion. So if the cycle started from the bottom, then that is the area where we have a deflation or depression. Then this means that there is no money in the market and there is cheap products in the market. So nobody's buying them. So what the central bank going to do to increase the consumption in the market and the productivity of the market, he will cut interest rates, so will increase borrowers, and he will supply money to the market by intervening with the open operation market. So when he supply money and cut the interest rate, now the productivity of the firms will start to raise up, and we call this area the recovery area, and it will hit the target. However, the central bank, he cannot control and maintain the target level because it depends on the consumption of the household and the productivity of the firm. And that is something cannot be controlled easily. So what the central bank will do, will stop raising interest rate the moment he hit the target. But remember that the central bank is already has put money in the market and he has issued loans to the people. So people is still having money. So from the target area, the expansion term will continue and will hit the peak of the cycle. And we call these the expansion. That is the recovery, and this is the expansion. Now, the recovery takes 2 quarters, and the expansion takes 2 quarters. Now, this is the area where we will be having too much productivity and too much inflation, and this is the area where the central bank will intervene again in the operation market, and he will increase the interest rate. So he will pull the money from the market. He will reduce the supply, so the demand on the money will be more. Then that is the area where the economy will start to go down. So now the contraction terms will start, and this is starting from the peak high where we have high inflation, high productivity. That is the area where the central bank will start to increase interest rate and will reduce the supply of money in the market by intervening with the operation in the market. And we call this from the peak to the target the recession. So the recession will take 2 quarters as well. So now we will be ending by having 6 quarters. And also when the target for the productivity and the inflation has met, the central bank cannot control and maintain that as well. So we will be ending by continuing into the depression session, and we're gonna go to hit the lower peak, and that is the area where the productivity will be low and we have deflation or depression. So we call this section as depression, and that is the area which is similar to this area where the central bank will start to reduce interest rate again and supply money to the market. So if you realize here that the economy cycle is taking 2 to 4 years to be completed, and this is the short-term cycle. So whenever the productivity at the peak and the inflation at the peak, we are having a money value going up. Whenever the inflation and the productivity at the bottom, we will be having the money value going down. So you need to keep this in mind as a trader. So now what you need to take as a trader from these videos. So first of all, you need to understand also that the CPI is lagging indicator. It's not something gonna go to tell you something in the future. And if you have the CPI and the GDP at the highest level, the central bank will use the tool of adjusting interest rate and the value of the USD will raise up. So however, if the CPI and the GDP at the bottom peak, the central bank will use the tool of interest rate and will print money. The value of the USD then will go down. The short-term economy cycle will take 2 to 4 years, and that is as the following. So the expansion or the inflation cycle is minimum of 4 consecutive quarters. So the recovery session will take 2 consecutive quarters as a minimum. The expansion session will take 2 consecutive quarters as a minimum as well. And when it comes to the contraction cycle, it's also a minimum of 4 quarters, and the recession session will take 2 consecutive quarters, and the depression session will take 2 consecutive quarters. This is important for you guys for the period time. If the prices goes up, you know how many months it's gonna go to take. So recovery will take 2 quarters, which is 6 months. The expansion will take 2 quarters, which is 6 months. The recession will take 2 quarters, which is 6 months, and the depression will take two quarter, which is 6 months again. So we will be ending of having 2 years of expansion and retraction. So normally it goes more than that, but however, this is the minimum. If you want to find the CPI, you can find it on the Forex Factory, and we have explained how to reach out the Forex Factory. So you can access it on the Forex Factory, so you don't need to do all the calculation which we have done. This is only to understand how the CPI works. However, all the calculation is ready made for you in the Forex Factory and being calculated by the economics. You just need to understand when to apply the concept and to anticipate when the peak of the productivity happening and when the peak of the inflation happening, and match them together, and at that point you create your decision for trade based on economy indicators. So now guys, I hope that this video was useful for you. If you like it, please give the thumbs up, subscribe to our channel on the YouTube and the Telegram. This is Ahmed Al-Azaiza of Forex Trading Signal was speaking to you, and see you in next training video.